All right, welcome to Kirk Spano's Fundamental Trends. It is Friday, April 27th, and the world is bouncing around. We have Kim Jong-un in South Korea stopping by for a social visit. We have President Trump just got done with a visit, or a visitor in French President Macron, who believes that President Trump is going to end the nuclear deal with Iran. Go figure. Where would you have heard that 6, 7, 8, 9 months ago, or maybe a year ago? Right here. And that's coming. In the blog that I did announcing today's meeting, I did note the whole string of oil articles that I've written. Put last week's webinar up there, talking all things oil. Then this week, I did another interview with Dale Pinkert over at Forex Analytics. Tell you what, these are pretty good interviews. And after I listened to them, going all the way back, man, did we hit some of these right on the head. So, I've got a couple of things that I'm good at. Those are the things you probably ought to really take away from me. And I understand energy. I understand commodities. I understand value investing in growth stocks. And when I say value investing in growth stocks, it means just that. You're looking for growth opportunities that you can get at value prices. And the place that you usually will get that is in the small cap stocks, which I'll throw up our first chart of the day. We can see that since the correction started to happen, the small cap stocks have outperformed. Why is that? It's because people pile into the S&P 500 because that's the option they have in their retirement plans. It's what they understand. They very mistakenly think that the large cap stocks are safer than the small cap stocks, and that's where the money goes. So when the large caps get overvalued and start to correct, the small caps have less correction to make because they sometimes are trailing the large cap rallies, which is what had happened. From here on out, I would expect the small caps to outperform the large caps for an extended period of time. And I think that that may be true globally because the large cap stocks have taken in so much money from indexers and from people who just, like I said, falsely equate safety with stocks that are at the top of their S-curve, that I think that people really need to do a major rethink about large cap and small cap investing. In the small cap world, you're looking at 500 million to $2 or $3 million companies. 500 million, 2 or 3 billion. That's really what I consider small cap. And then from that 2 or 3 billion to 10 to 20 billion is mid cap, depending on the industry. And then 10 to 20 billion and up is large cap. And then you get into the mega cap stocks that dominate the S&P 500. So those top 50 stocks in the S&P 500 pull those averages way up. People see the stocks going up like Google and Facebook and Amazon and Netflix. You go right down the list of those well-known names, and people just pile in and pile in and pile in. They push that number up and up and up and up, that price, and you get greater fools. And greater fool theory, if you've never heard that before, you ought to Google that, right? Not search it, Google it. But the small caps are probably where I've made the most money in my career. In fact, it's not a probably. It's hands down. I've made the most money in small caps, then mid caps, then large caps. Why is that? Because an S-curve, and I really should have shown you an S-curve, but it is what it sounds like. Companies start small, and then they start to grow, and then they have this very large upward growth period, and then eventually the growth starts to slow down and the S starts to turn over. So the curve starts to turn over. And it looks like an S. And that is something that I think people need to wrap their heads around, is that once a company passes from micro cap to small cap, right? They get past that period when they're more speculative, when they don't have business, when they're not cash flowing, and they're not really any higher risk than, say, a large cap company, say General Electric, that simply can't grow anymore because they're too big. They've gotten too weighted down with legacy problems, and they're just too big of a ship to turn quickly and to really ramp up the speed on. So when you take a look at small caps and large caps, here's what we know. Small caps have outperformed large caps forever. That has changed recently with the advent of index investing and using the S&P 500 index in particular, which is market cap weighted and just keeps throwing money at the large cap stocks. That will eventually lead to a very bad, sharp snapback in the stock market. I've talked about that in the past. Here's our next chart. I haven't updated this. This is from a little while back, but we're up here, actually over here, and this is a pretty strong level of support right around 2200. And some of the technical guys are saying that for some reason they're pointing at this area here. I didn't even know I had my scroller on, but a lot of the technical guys for some reason think that this level right here is a big deal, and that if we break through here, which is like 2400-ish on the S&P, then we go down to here. So I guess this is an intermediate level that some of the technical guys are pointing to. It looks like a pretty weak support level to me. This looks like a strong support level to me. And then, of course, if there's a crisis, go all the way back to the old resistance, which we broke out of, so therefore it became the new support. And in the event of a severe recession or financial crisis, I think you see the S&P 500 go down to around 1600-ish on the S&P 500. And these are just very simple measures. This could hold long term, although, we tend to like to have crises. And I said in the most recent interview with Dale Pinkert, I think we are most likely to have a crisis in 2020. It is Japan Olympics and our elections. Why do the Japan Olympics matter? Because they're having a huge build-out right now. And usually after those build-outs are done, an economy really suffers. And I think Japan, with its combination of massive debt, demographic problems, and really no resources of their own, and coming off of a stimulus, eventually Japan has to have a reset. And Kyle Bass has been talking about this for years. Surprisingly, but Kyle Bass and I seem to be on the same page on a lot of things. And I don't really read him. I just see him in the press, but it seems like we end up in the same places a lot. So either he is really smart and I'm keeping up with him, or I'm really dumb and I've picked a bad guy to emulate. But I think that probably it's somewhere in between. But I do see the S&P 500 someday getting down to 2200 and maybe getting down to 1600. And really, this is not an unlikely event. What is an unlikely event is that the S&P 500 comes all the way back down into this range again. Some of the doom and gloomers, some of the guys who thought that we would not break through this level, they thought that we'd go back down to the 700 range on the S&P 500 again. It's probably never, ever going to happen, short of a depression that the governments and central banks just shake their head at and say, yeah, let's have a depression. You need to understand that There's political pressure. There's a big skim on the planet for the super wealthy, and the super wealthy can't skim if we're in a depression. So I think that the likelihood of us getting more quantitative easing someday, and ultimately I believe that helicopter money is inevitable. It'll probably be used to bail out the pension system and do a few other things that will not create massive inflation, but it will create massive changes in the market and volatility. So somebody asked me this week on I think it was on our website. It was one of the members who I don't really see eye to eye with on many things, but and he's got a bit of a chip on his shoulder. He was talking some very serious Austrian economics and how the only way to solve debt problems was to pay off debt honestly. That is so untrue, it's unbelievable. So at the personal level, yeah, we all need to pay off our debts or we go bankrupt and start over, and there's a penalty for that. But at the international and national levels, inflation has always and will always play a part in paying off debt. That's just the way it is. The reason why we have 2, 3, 4% inflation is tied to the growth of the population, and the reason why we increase the monetary supply, growth of the population. The reason why we run a budget deficit is growth of the population. If the population growth ever stops, then we have to see balanced budgets. But population growth probably will never stop, at least not in the very foreseeable future. So even though those curves are turning over, right, there's a slower rate of population growth, there still is population growth. So think of a curve that's sloping up versus a curve that's starting to turn over. That turnover period takes decades. We know that there's going to be 9 billion people on the planet, give or take, by 2050. So we're going to continue to see inflation. We're going to continue to see increased money supply. And because we've overspent those numbers, we're going to see more inflation. And we're going to eventually see what I call helicopter money. Stole that from Milton Friedman and Helicopter Ben, obviously. But the pensions in America, and Lance Roberts just wrote an article about this that I'm going to repudiate. The pensions in America are only about 60 to 70% funded. Social Security in about 20 years is only 70% funded. And the student loan debt is over $1 trillion, which is hampering an entire generation from spending. If the United States prints money without creating debt to fill those gaps, what you would get is that money trickling into the economy over a very long period of time. So there would be some inflationary pressure, but it would offset the deflationary pressure from the demographic of an aging population. So you have competing forces of inflation and deflation that we're going to face for a very long time. It's not cataclysmic. It's not unsolvable. But the articles you read and the narrative you get make it seem that way. We've done just fine with quantitative easing. There's more money saved in retirement plans now than there ever has been before. The millennials are saving double what the baby boomers saved at similar ages. Granted, just like every other demographic, that money is skewed to the top 20% of the millennials. However, more millennials are saving than boomers did, and at the top they're saving more. So this idea that the millennial generation is going to fail us is probably wrong. And ultimately, as long as we solve for some of the excesses of the 70s, 80s, 90s, and 2000s, which is where we had our problems, overspending, the Clinton administration and the Republican Congress, until they screwed up at the very end with deregulation and some other things, did a very good job of bringing the numbers back to where they belonged by 1999. Of course, they deregulated the banks in 1999, got rid of the Glass-Steagall Depression era protections, and we know how that turned out 8 years later with help from loose money and derivatives and a lot of other things, fraud. But in any case, the world keeps going, and there's going to be good and bad days. There's going to be good and bad markets, but you can make money in both directions. So all we need to do is realize that the long-term trend is up, always has been, always will be. But that from time to time, there will be short-term periods, 1-2 years at a crack, where the stock market really stinks. I think there's a possibility if we get this rally to 3,000 that I'm talking about, that we might get a 3 or 4 year period where the stock market is very range bound and the indexers make almost no money. I think that would be good. I think it'd be good for the indexers not to make any money. Why? Because at this point, indexing is starting to be self-defeating. It is helping to create the bubbles, and the folks who are investing don't understand their investments. Now, one of the reasons that I believe that Warren Buffett says, hey, a lot of people should index is because he just realizes people don't understand investments, and he got tired of trying to explain it after 50 years of writing letters that most people don't read. I still run into people who ask, what is Berkshire Hathaway? So, but they invest, and they play the stock market, and they don't know what they're doing. So if you want to really become good at this, you're going to read a lot. You're going to throw away a lot of the ideology that you have. You're going to stop with the self-validation, the rationalization. You're going to look in the mirror. You're going to say, look, I want to have fun with my life. I want to have a good time. I want to make some money so that I can have fun and have a good time. Right? That's what it all comes down to, and security. So when we look at these charts, we think things through. I just want people to understand that in the long run, things always work out. Does that mean that it'll be perfect for a year or two at a time? Absolutely not. And I do think we're coming up on one of those periods. Back when I wrote the buyback bubble will end badly, I told people that the stock market has shifted from buy the dips to sell the rips. And I do think that that is generally true. However, if this market is going to run up to 3,000, and I believe that it is, or close to that, we probably need to be net buyers right now, temporarily, because this is a pretty good trade. The 200-day moving average has held every week that it tested it, and it's holding it right now. Stock market's about even today. Unless it sells off, I think it would have to be like 600 points this afternoon, right? What would it have to sell off to get to the 200-day moving average? We'd have to sell off a lot this afternoon to finish the week below the 200-day moving average. And that's something that you need to understand about technical analysis. The weekly charts are much more important than daily charts or hourly charts, right? If you're a day trader and a swing trader, then those daily and minute charts make a difference. But if you are like me and you're looking to hold for months at a time to years at a time, then you want to take a look at the weekly chart. And what we can see here is that, yeah, we'd have to sell off 800 points this afternoon, right? Is that right? 80 points, my fault, to get down here. It's not going to happen. So once again, like here and like here, we're going to hold the 200-day moving average. So I think it's much more likely that we get a bounce than we get a dive. Eventually, we're going to get that line. When we get that line, we should be prepared for it, because we already know that this is going to happen someday. And we think that this will happen at the next crisis. And whether that is, right, is that going to be here? and then there, and then there, and then there, then there, and then you'll have your holy shit moment, right? And then you'll get that. Is that what's going to happen? Who knows? But something like that makes sense in my head. Out here, I guess that's not very to scale. I think that 2020 is a dangerous year. I think that this year is probably going to have a good second quarter, a challenging third quarter, and a big rally to end the year. So if I had to give a prediction, that's what I would say. I'm going to close this without saving because that looks bad. And here's why I think we are going to get a good second quarter. A lot of buybacks, right? The buybacks in the last month have been low because of the blackout period going into earnings. Those buybacks are going to start kicking in here any day now. They're already kicking in, right? Companies that have reported earnings can start doing their buybacks a couple days later, 48 hours later. For folks who subscribe to Margin of Safety Investing, I wrote about testing the 200-day moving average, right? And I had that chart in there. So we held it. And I went back to the conversation I had with Mark Yusko way back last July, where he was saying that we were in the euphoric stage of the market up here, Delusion. And I said, nah, I think last summer we were just still at enthusiasm. Now, by January, we started to get greed as the millennials started telling me how well Bitcoin was going to do for eternity. And we got a little correction. The line doesn't always move exactly like that. But we haven't had Delusion yet. And maybe things are a little different this time, right? Sometimes reality repeats the past. But more of a rhyme, right? I don't know the saying, but the future might rhyme rather than an outright copy what's happened in the past. So in today's world, where you have baby boomers who are in net withdrawal from the market, that's true. Baby boomers are in net withdrawal from the market, and the millennials are just starting to make money. And my Xer generation is doing very well, but there's just not many of us. Maybe the top of the market is more choppy than it has been in the past, right? We had that incredible low volatility year last year, a record low volatility year, and this year's shaping up to be a high volatility year. First month was really good, a couple of choppy months. Now we have all the cash coming from the repatriations starting to funnel into the buybacks, and that's probably going to hold the market up. I think the next 8 weeks are going to be pretty darn good until what? Until we start hitting blackout periods going into earnings again. And then you have July, August, September, when usually the market is fairly challenged because of low volatility, a lot of people on vacation. Sounds like a funny reason, but we know it's true. And then come October, which has had a couple famous crashes, but generally is a good month. October, November, December, I think you start to see after those earnings, those October earnings, you might see a massive Santa Claus rally. So, all the things that I'm looking at are saying choppy market, upward trend, going to get to 3,000, which is a psychological level. If it doesn't get to 3,000, so be it. But I think it's going to make that run. And the buyback bubble isn't done, which is what I keep telling folks. We're going to get that rally. Now, does it stop here? Maybe. But I think it breaks this. I think it gets all the way up here. And we'll see if I'm right or if I'm wrong. And remember, I've been a cautious guy. I've been cautious since 2015, holding around a quarter of my money in cash, although my positions between the options and some of the high beta stuff that I do have tremendously outperformed. Last year I talked to folks about my results, and I was able to show those because the brokerage I'm with, Interactive Brokers, TipRanks likes me. Interactive Brokers does a composite. I don't manage a lot of money anymore. I'm trying to move into full-time investment letter and publishing, and maybe crank out a novel someday in between playing poker tournaments. But last year, 48% return. How? How did that happen? Well, granted, we had a home run stock. Exact Sciences went up almost 1,000% for me over 18 months. And I think some of these oil stocks, while they won't go up 1,000%, I've got a lot more of them. And I think a lot of them are going to go up 30, 40, 50, 60, 70, maybe 100%. And can we get 48% again this year? I don't know. But I think 20-ish is probably a good target for this year if you're overweight the energy stocks, which I keep talking about. So let's shrink some of this. Talk about other people who are getting on board with this whole 3,000 thing. And again, might not quite get there, but it could get close. Big long list of people getting on the S&P 500, getting up to 3,000 camp. So what would it be led by? Well, as you can see today, the FANG stocks are doing well. But an old grumpy guy who called the last two crashes, Jeremy Grantham, he was talking about a melt up in stocks. And he has an update to get to that. JP Morgan, Oppenheimer. You just go right down the list. Whoever this guy is. This guy. JP Morgan. Oppenheimer. I don't know, somebody. Who cares who it is, right? More JP Morgan. Now, this JP Morgan guy says, still think it's going to go, but it's going to be choppy. That's what I just said. It's going to be a choppy market. Ultimately, the trend is up. So even though I want to sell the rips because I ultimately want to bring my asset allocation of stocks down, there are going to be some ebbs of being a buyer like we have been in the last week. So yesterday we bought AT&T. I think that was a pretty good buy. It's up a little bit today, I believe. Now, going back to Grantham. If you don't read Jeremy Grantham, please read Jeremy Grantham over at GMO. He is maybe the best forecaster in the world, certainly a better forecaster than Warren Buffett, who's a stock picker, right? So this guy's a forecaster. Buffett is a stock picker. I listen and try to learn from both of them. Grantham points out that emerging markets are probably the place to be longer term because they're lower on their S-curves, right? And my subscribers know that I really like India. And I like a few other countries too. I think that there's times to buy Brazil. I think there's times to buy Vietnam. I think there's an argument for Indonesia. And then a few Eastern European countries. And what do all the countries that I like have in common? Rule of law, right? They don't just take your money. Young populations that are educated, maybe some natural resources, and not perpetually at war. Technologically advanced. India, with that giant economy, seems to me like it's going to be the most likely to be like China was the last couple decades. The difference being India won't steal your money, right? China might. So I prefer India to China for that reason. Grantham did do a little update here, and what did he say? He basically said that, hey, I still think the market's going to do pretty good short term. However, and this might not be the Grantham article. Yeah, it is. But it's probably going to be choppy, and there are a couple of threats. And the threats are what? Things that we've covered already. We've already covered tariffs, right? We've covered the tariffs. We've covered the possibility of war. But ultimately, with the tariffs, this is what I think. Expect positive surprises. There just is no motivation from anybody, including President Trump, to blow things up. What he wants is he wants marginal gains, and he wants wins. So to the extent that the trade policies are getting negotiated a bit, just understand that in most cases, you're going to see small marginal changes. You're not going to see hyperinflation. You're not going to see a complete breakdown in the system. If you do, right? If you wake up some morning and China says we're in a trade war, sell everything, ask questions later. But the Chinese haven't responded that way. They've said that they'll reduce their trade deficit with us by $50 billion. That'll take some years to do, but if that's the path that they're willing to go on, then I think that that's probably a great deal. If they start buying more oil and gas from us, which is very likely for a couple of reasons. One, we have it, they want it. They're the biggest importer in the world. We're becoming an exporter. And if the sanctions on Iran snap back over the next several months because the Iran nuclear deal has ended May 12th, then China has got to make some decisions. Do they want to defy the United States on that and be blocked from some international trade, which they're not ready to do that. So they don't have an international enough currency to do that. They'll probably end up buying some oil and gas from us. So, they've already, Secretary Ross has already talked about that. And I think that is an incredibly likely thing. That is why I am in Antero, right? So subscribers know that I like Antero as my natural gas stock. There we go. Try to clean some of this up. And I have a new toy. I used to use FinViz. I'm starting to use it again. I'm trying to learn. So here's the heat map for this week. What do you see? Energy has done pretty darn good. XOP, which I compared in an article to XLE, is leading XLE. Why is that? It's because the oil majors just aren't the place to be. Why would you be in Exxon and Chevron, which are near the top of their S-curves, right? Number one, have massive legacy problems. They have all sorts of assets all over the world that are never, ever going to get developed. But, one, because they're too expensive, and two, they're too long cycle. If you don't understand that yet, I'm not going to spend an hour explaining it again. Go read the articles. The long cycle assets are not going to be the place to be, and that's largely what Exxon and Chevron have. So the XLE is loaded with Exxon and Chevron. XOP is loaded up with companies like EOG and Pioneer and Occidental and Encana, which are companies that I really like. Why? Because they're focused on U.S. shale and some in the Gulf. The Gulf has done well. And they're outperforming. Bottom line, they're outperforming. And that is coming up from, they trailed for years, and now they're going to blow by. So keep that in mind. Energy Complex is doing well this week. This is a weekly chart. Volatility was up a little bit. There's some utilities out there. I think Dominion is darn close to being a buy. I traded it once, but it's not something I would tell you to run out and buy right now, but I like Dominion among the utility companies. There is some play in the financials, but I'll tell you what, I think ultimately the financials are very disappointing. There is a lot of derivative risk, a lot of recession risk inside the financials, and if the economy starts to tighten up, the first thing that's going to happen is interest rates are going to come down again. That's bad for the banks. The economy slows down. Bad for the banks. Somebody has a crisis overseas, bad for the banks. There's just not a lot of upside in the banks. Couldn't they chug along a little bit? Yes, they could. But in reality, the banks just have very little upside unless you're finding some of these regional banks. Some of the regional banks right here, KRE, that'd be a place to be. But XLF, I wouldn't bother with it. I don't want the big banks. Now, some of these regional banks are pretty good, and that's a spot to do stock picking in. Unfortunately, picking a regional bank is something that I've learned you need to be in that region. You need to understand the business on the ground that that bank deals with. So to the subscribers out there of Margin of Safety Investing and Fundamental Trends, if you're somewhere in the country and you know of an awesome bank, maybe you party with the guy who's running it, which I know the president of a bank here, who's taught me a lot about the banking system. Some of those regional banks or state banks are very profitable. And if you understand something like that, bring those ideas to the group, because there are those really good banks out there, and they pay 3, 4, 5% dividends, right? And that on the ground, the area is just starting to see rising real estate prices, just seeing an inflow of business. Some of the banks in southeastern Wisconsin, I think, are going to do very well in the future. They're tightly held, so they're hard to get into. But with Foxconn and other distribution chains coming in here, including Amazon is here and expanding, that corridor between Milwaukee and Chicago is finally developing. We've known it should develop for 50 years, and it's finally happening. Part of that has to do with supply chains coming back to America, which is really what President Trump has been pushing for. Whether he knows that's what he's pushing for or not, I still can't figure the guy out. But that ultimately is what he's doing. He's bringing supply chains back to America, and that's important in a slow growth economy. So having the supply chain gives you insulation against economic shocks in the future. All right, Micron. Somebody asked me about Micron. I just wanted to show you. It consolidated in here between 40 and 50. It's down into upper 40s at the moment. Is it going to hold this line here and then rebound and resume its trend up, or is it going to test the bottom of this range? Great answer for you. I don't know. If it breaks through here, it probably goes down to the low 40s. At that point, not only would I probably sell puts, I'd probably buy calls with a premium. Here, you can be a put seller or buy a small position. So what's the long story on Micron? Right now, see, we don't know if they're going to become a seller. We don't know what direction they're going to move. Is this. They are cleaning up their balance sheet quickly because they're making a lot of money. And eventually, their total liabilities are going to come down by another $3, $4, $5 billion in the next couple of years. Why? Because the DRAM market is very profitable and it's very tight right now. The demand is real high, and there's no new factories coming online. So there's only 3 companies that make all the DRAM. It's Samsung, Micron, and the SK. So they don't have more capacity. They're all at capacity. Eventually, the Chinese are going to bring a factory online in about 3 years, I believe it is, 2-3 years. I was talking to one of our subscribers about it a week ago, who's in that industry. The cycle for semiconductors is nowhere near being over. NAND is a little bit weak right now because there are more companies that make that. But the DRAM, which is what drives this company, is going to be strong for a couple more years. And as we build out more and more technology, artificial intelligence, virtual reality, augmented reality, all this stuff that requires processing power, this is going to do pretty well. Ultimately, they have the X point, 3D X point. Probably not going to make a difference for a year or two, but that is going to be out there, and that'll challenge the NAND in some spots. And maybe be used for new devices, I think. So we'll see. But Micron, I think, is either a buy right now, but if it does come down a little bit, it's a big buy. If I had to guess, I think it's going to hold this line. So you might want to nibble in or sell some cash secured puts. Exact Sciences, I'm going to finish with before I jump into any questions. Everybody knows that this is the one that I made a ton of money on. So way back, I bought a whole bunch of Exact Sciences in here with a lot of calls. And then they got FDA and Medicare approval. Made a ton of money. Started selling it. Then it came down. Oh, wait. I have to go back here. There you go. I got it wrong. This is when it got their first approval. In any case, backed up the truck on the crash. Stock ran up to 60. Right? I wrote to clients to be selling the stock right around December, November, December. Stock came down, bottomed out, looks like in the upper 30s. And now it's rallying with yesterday's earnings, jumped. Now, I'll tell you, I don't know if this is good that this just happened. I think this gap will get filled eventually. However, I don't think we're going to see upper 30s again. I think that this is the consolidation range. I think we'll get back to it. I think the folks who are trading it right now probably ought to be taking profits. Why? Because Exact Sciences growth hasn't been quite what they want it to be. It's good growth, but they blamed a lot on the flu this winter, and I think that's legitimate. But that growth curve needs to increase, and we need to see it. What they're saying and what the evidence seems to point to is that as the doctors can order online rather than using paper, the adoption rate in the office goes up dramatically. I believe that. How long does it take these doctors to get online? How long does this all happen? I'm not sure. I went and revised my estimate at Estimize. I do think they're going to do fine. I think that the stock is getting to the point of being fully valued again. Around 60, I'd say it's probably fully valued for the next year or two. I'm starting to question whether the stock gets to 100 by 2020, which is what I had thought, because I do think there's going to be economic headwinds by then. So we'll see. But as Kevin Conroy, the CEO, told me, Exact Sciences is not a speculative story anymore. It's an execution story. So we need to see that they execute, and I think it's going to go to 100 eventually. Is that pushed out a little further now? I'm not sure. I know that their drug pipeline, their test pipeline, is not coming along as quickly as they'd like it to. So I'm not bearish on Exact Sciences, but I think the easy money was made. I think when the stock was single digits, people who loaded up there and took some profits in the 50s and 60s, that was the easy money. That was the 4, 5, 6, 7, 800% move. We're not going to get a 4, 5, 6, 7, 800% move anymore. We're maybe going to get a double. And there's a big difference in the way that people look at investing than I do. I don't get excited by saying something might go up 30 or 40 or 50% in the next few years. Why? Because of the risk associated with equities in general. I can buy ETFs and avoid single stock risk and probably do just as well as 9 out of 10 stocks in the market, right? I'm going to get a little bit better than the index if I asset allocate correctly. And if I'm really overweight in something that takes off like energy, I might have a really good year. Or maybe I can buy Brazil at the bottom. Or maybe I can buy India after a big correction. So asset allocation for most people is underappreciated because it really can make big differences in your portfolio, hence why you need to be looking for reasons to get into emerging markets. As far as the stocks go, if a single stock can't double or triple in the next 2 to 4 years, I just don't want it. There's just not enough upside for me to take single stock risk, given that a competing test for this company could come out. It won't in the short term, but it could in the 2020s. CEO could die. COO could leave. CFO could screw up. Something, right? Slow adoption, whatever. FDA has a change of heart. I mean, a lot of those things are very, very, very unlikely to happen, but it's not as if they don't. So if you're going to take single stock risk, build in that bigger margin of safety that I keep talking about. It's what Ben Graham and Warren Buffett and Peter Lynch and all the great investors, Clairman, talk about. Have that margin of safety. Don't be a chaser. Saying, oh my God, Facebook might go to 200. So what? It's already 170. Who cares? Seriously, who cares? Go find a $20 stock in a $2 billion company that might become a $6 billion company and get the triple. All right, I'm going to end on that. Let's take some questions. Yeah, I like SMIN for India. There's another India ETF that I have to put in there. I forget what it's called, but INDA is actually in that list. So SMIN and INDA are the two ETFs I use for India. Right now I'm not in India. I'm looking for a better spot. In the solar arena, I gather there are two technologies. Thin film versus silicon. Yes, I have gone into depth on those. There's not a lot of point in me rewriting what other people have written. So you can get real good information on the difference between silicon and thin film, what they're good for. There's also even bigger upgrades in solar technology coming. My favorite stock is SunPower. Why? Because they're cheap and they have a huge growth rate and they're backed by Total. And every time I say they're backed by Total, somebody says, no, they're not technically backed by Total. Folks, they're backed by Total. Go read Total's documents. Go read SunPower's documents. Total is behind SunPower, 100%. So, and they own 80% of the company or 65% of the company. They might have changed. First Solar is pretty good too. We bought them around 40. Dominion is pretty good here in Virginia. Very good management. Yes, Dominion does have pretty good management. The Scana deal has turned some people off. I don't think it should. I'm very familiar with those power plant projects, the nuclear power plant projects. A couple of clients of mine worked on them. They're going to come out of that pretty well by taking over Scana, presuming that goes through. The pipeline deal from FERC doesn't really hurt them. So I don't know what price we want Dominion at. I mean, we're closing in though. It rallied today on something. So it's below its 200-day moving average, consolidating here. Now it jumped. This, I have to see it play out a little bit more, but that looks like it's probably ready to rebound. And when you take a look at their cash flows, you see the fact that they've got a 5% dividend, which maybe that's what's drawing some people in today. And it seems to be a good day for certain industries, for utilities. I like Dominion. I like the fact they're going to be exporting LNG. I like their East Coast pipelines. There's a reason why. So there's a FERC decision, FERC. They had to do with not being able to take certain tax expenses on pipelines. It doesn't really affect anybody. there's very minimal impact on the players because they've largely known that that could change and they've adjusted. There are several companies that are impacted. There's no doubt about it. One of the companies I like is Kinder Morgan because they're corporate. They're not an MLP, but you have to look at the quality of the asset above everything else. The best pipelines transport natural gas all over the country or are in specific regions where they're short on transportation, such as the East Coast or the Permian Basin. Dominion is very good on the East Coast. Yeah, I'm not going to bother with the copper and other base metal stocks for a couple of reasons. One, they're very, very capital intensive, and if interest rates really do get higher or liquidity does shrink up, they're going to have a problem. Rio, BHP, Freeport McMoran, they're all decent stocks, right? I mean, they're all decent companies. But the question I ask again is, do I think they can double or triple in the next 2 to 4 years? Then I stretch it out the 5 to 7, but 2 to 4 is what I'm really looking for. I don't know. What would it take for BHP to get to $90 a share? Nothing short of a record rally, right? Do you see that coming? Nah. Could they go up 10 or 20 bucks? Sure. That's not exciting to me. I can use an ETF to do that. So, SPDR. What's the symbol for their basic? So do they just call them materials? Okay, there it is. XLB. I'd rather be in XLB than I would be in almost any one of these companies. BHP's not even in here. But Freeport McMoran is, right? DuPont's probably my favorite stock in there, and it's the biggest holding. If you really see good things from materials, I'd probably own this. And I will tell you one situation where I do think I'd own this. If the Democrats take Congress, I probably want to own this. Why? Come on, somebody put the answer in the chat. Why do I want to own this if the Democrats win Congress? Come on, it's easy. It's easy. More spending? No, come on. Better answer than that. No. Infrastructure, yay! There you go. Somebody got it. Yeah, I was going to wait you out on that one. Yeah, if the Democrats get into Congress, we're going to get an infrastructure bill. Why? President Trump wants one. Democrats want one. A whole bunch of the Republicans, the so-called rhinos want it. I think the rhinos are the real Republicans, but, I think that if the Democrats get into Congress in November, you're going to see an infrastructure bill. So keep an eye on those polls, and you probably want to buy this about a month before the election and hold your nose and see if your projection is right. So if the Democrats are going to win, then this becomes something to buy. Now, if we get that bad third quarter like I talked about, maybe you buy this in September. Maybe it gets added then. All right. What was that website? Show MU balance sheet. Y charts. Market trend signal. I have like 3 different cheap subscriptions, or not cheap, but just subscriptions to quantitative data sites. So these guys use their algorithm. There's a couple other algorithms I use. I like to see how they look compared to each other, what they say. So they all have the same chart. And one of them will say it's about to turn around. One of them will say it's about to keep heading down. I try to look for similar opinions. So rather than spending hours and hours and hours writing algorithms and back testing and things like that, there's people out there that for $399 a year will sell you their algorithm. Why not just for $2,000, whatever it is I'm spending, why wouldn't I just look at a bunch of different other people's algorithms? Am I going to really outsmart them all? No. Let's look for consensus. And, what's that trading company that's all over the country trying to teach people how to trade? They have radio shows and whatnot. But, all trading revolves around trying to figure out where the money is going, right? Where are the institutional buy levels? What are the big algorithms planning to do or trying to do or doing, right? And it changes a little bit all the time because they're jockeying with each other. So all you can do is look for what are the more consensus signals. And, this one has been produced. I pulled this one up because A, it's easy for me to cut the chart out. And B, I like the scale they do. And I have found that when a stock gets to here, it almost always rebounds. And when a stock gets to here, it almost always drops. It's been remarkably effective. So when I tell you to buy or sell something, you can count on it being in here somewhere. If I'm telling you to take some profits, it's almost universally up here. If I'm telling you to buy it, it's almost universally in here. And it jives with the technical analysis. Because, as I've told you, that Chaikin money flow is pretty interesting to me. So right now, Chaikin is actually showing some money going into materials. So this is called a divergence. Money is flowing in, but the stock price actually came down recently. So when money's going in, but stock price is coming down, that usually means there's a reversal coming. So could you buy this? Sure. How much are you going to get out of it? I don't know. It looks like the money flow probably peaks out here soon. So that means that maybe you get up to here and then it turns over. Do you really want to screw around with a trade that you might make 3, 4, 5, 6, 7% on? I don't. It's not worth the time. It's not worth the risk. Property market crashing with the stock market, I guess. Well, I missed when you said that, Captain Boji. Can you put that up there phonetically for me? Impinge just hit strong support today. I think we need to do the research on Impinge again. I don't think we can just use the signals. I don't know if they're actually starting to sell stuff, right? That was the problem, is they just completely missed their revenue numbers. That's what you need to figure out. Boy. Did I say it right? Boy. I. All right. All right. Do you expound on India and China? China steals. India doesn't. There. I like India better. All things being equal, which they're probably not, I like India better than China because India is much less likely to steal from you. Okay? That's pretty easy. Although I think Tencent's a pretty good company. And I think China, is it China Mobile? I'd have to look it up again. One of the Chinese telephone companies looks pretty attractive. I think it's China Mobile. I get the names mixed up. Sierra Wireless. Yeah, everybody will be. Yeah, will they be impacted by a recession? Everybody is always impacted by a recession. What is the downside risk to AT&T if the Time Warner deal fails? I think that's a long-term risk, although I'll be honest, I'm not sure that the Time Warner deal falling apart is that big of a deal. I'm not so sure that it is. because ultimately I think AT&T is just going to start pricing its pipe more. They're going to charge you more for getting internet access, and I think they're all going to do it. There's going to be more consolidation in the telecom space. I think some of the regional wireless companies are going to get bought up. I think U.S. Cellular that's why they're on our list. I think at some point they get bought. I don't know why T-Mobile and Sprint keep trying to merge. I really don't understand it. I think that Sprint should be out there buying companies like U.S. Cellular. I don't know, is Metrocom on their own? Some of the larger regional companies should be getting bought by T-Mobile and Sprint. That's what should be happening. I don't know why it's not. I don't know why they want to force the T-Mobile Sprint merger. Is this the third or fourth time they've tried? Who knows? Oh yeah, I still own CenturyLink. I think CenturyLink's got a ton of upside. I think that it's an asset that somebody else is going to want to own at some point. And I think that their enterprise side is going to do very, very well. They've got a global network, so global business. CenturyLink is dramatically undervalued to what their assets are worth. So ultimately that will play out. Do I think they'll get bought out, taken over? Maybe. I could see them merging with a wireless company, right? So the technology that's coming, for those of you who aren't reading up on this, the technology is coming that the last mile, right? The last mile from the big pipe that's under the big road, the big internet connection, rather than connecting your house to fiber optic, which they do almost nowhere. You might start seeing, and because there's been an improvement in the technology, you might start seeing mini wireless networks, so that rather than you even having a router in your house, you might just get the signal from a wireless signal from a mile away, or probably less than a mile. But I don't know that they're going to keep bringing the physical wire into your house, because there's limitations on what copper can do. And to get 5G, I think they're going to get creative, and I know that they're improving the cable from the road to your house. I know that they're improving that. I know the technology is getting better, but I just see that all going wireless someday. So we'll see how that works. Now, if a company like CenturyLink buys a regional cellular carrier, think about what they could do with their infrastructure all over the place. They could create a pretty good system, and I don't think that anybody is going to ever build anything out that's new again. The infrastructure that's out there in telecommunications is the infrastructure that's going to be there for the most part. The companies that own it will be the ones that improve it. So if you want to get into that business, Google, you're going to have to buy somebody, because are you really going to go spend tens and hundreds of billions of dollars to wire the world? Or are you going to do it wirelessly? I think there's some sort of hybrid coming, and that's what it looks like. And we'll see. All right, it's been an hour. Last questions. Oh, yep, energy question. Encana and Taro, Kinder Morgan, all tied to natural gas volumes of pricing. Well, Encana is mostly oil. Gas prices still suck. This is a true statement. But we talked about the deal with China that's probably going to happen. Yeah, gas production is only going up with the associated to oil. So the natural gas market is like this. Demand is going up. Okay, that's a big part of the equation. Natural gas and oil inventories have both come down. Why? Injections, supply hasn't quite lived up to what people thought it would be. There is this notion that we just have all this oil and gas coming, and it's not entirely true. So even though the perception, the narrative is that there's just this massive amount of oil and gas in the United States, between what we're exporting and demand increasing, the inventories have actually gone down in the last year. So ultimately, that will drive natural gas prices up. I think natural gas prices will trail the oil prices because as we drill more oil, we get the associated natural gas and we're capturing that. So does natural gas come back quickly? No. Does it come back eventually? Yes. Is it cheap right now? Yes. So, you just put it on your radar, you buy a little bit of it, and you wait. Is there really much downside for Antero? Not really. I mean, they've been around 20 for, a year now? 19, 20? Yeah. Look at that choppiness. If you were a day trader, you'd probably kill it on this stock. So, that, my friend, is consolidation. At some point, that breaks out. And it does look like those curves are starting to bend, doesn't it? 50 and 200-day moving averages right on top of each other. That looks... We're getting close. I forgot what I was reading, but it looks like natural gas inventories will come down again this summer. So we'll see. As far as Kinder Morgan, they control the flow of natural gas. I mean, it's only them and a few other companies. So they're eventually going to see increasing rates, and eventually I think there's a good resolution on TransCanada. Their dividend is scheduled to go up. They already met it. They've got the cash flow to do it. And they've got 2 new pipes going into the Permian Basin, which will be very profitable. All right. I think that's that. Hopefully I talked some people off the ledge while making it real. There is the reality of the world that bad things happen. But generally, good things happen. And you just have to sidestep some of the bad things. And if you're a trend follower, which I'm not, but if you respect the trends, right? Trend followers are trading every day. But if you respect the big trends, when you see the breaks, don't be stubborn, get out of the way. We'll get a signal. We can keep our losses to 5 or 10%. Be cautious. Let the market do the work for you. And volatility is generally your friend. Understand it, accept it, don't be afraid of it, embrace it, and you'll find a way to make money. All right. Have a good weekend. I'm going to go help my daughter do some moving.